John Higgins, Mortgage One. Happy Tuesday. Hopefully you had a wonderful long weekend and were able to spend that with family. But let's get back into the work week. Last week, the stock and the bond market were grappling with the news that Moody's, the last of the major rating agencies to hold on to the AAA rating on U.S. debt. Well, Moody's removed that AAA rating, and we know that this country has a tremendous amount of debt outstanding, and we're still running deficits. So competing with other nations when we go to sell that debt without this AAA rating, it'll be interesting to see what happens. As you'll see on the 10-year Treasury, it was kind of a back and forth week with regard to this news. So this week, the big news upcoming would be the Fed minutes from their meeting that ended on the 7th of May. So we'll get kind of some insight into what the governors were thinking going into the implementation of all these tariffs. And then the Fed's favorite gauge of inflation, the PCE, that'll be out as well. The Fed is targeting 2%. We are making some progress on various inflation gauges towards that 2% level. So we know that the tariffs have not fully been implemented yet. It'd be nice to see a little downward track on the inflation gauge that the Fed watches so closely. Where are we at with regard to the 10-year Treasury? Well, I mentioned that the number that we've been kind of focusing on is 450. Last week, we lost touch with 450. We hit above 460. But as the week starts here, we're starting to see a bit of a breakdown in interest rates. So that's good news. We'll kind of watch and see what this week holds for us. It's really been all driven by news events and not so much the internals or the economic news that's coming out. It's more political news and the Moody's news. What has that done for our mortgage interest rates? Well, over the last number of weeks, we've let you know that interest rates have been creeping up, and last week was no different. As Freddie Mac has put out their survey, we're at 6.86. I'll tell you that, depending on the loan to value and your client's credit scores, we're bumping around 7% now, and that's no good for home affordability. I think there's a study that was just released by Case-Shiller that shows that home prices continue to increase. So that in and of itself is not a bad thing. But as interest rates continue to rise, home affordability, which has been an issue over the last number of years, continues to persist. We'll give you an update next week after the Fed minutes and the PCE comes out. Until then, have a great week.